Let's do it. Who in this room wants to grow their wealth? Okay, that's good. I'm in the right room. Right on. Well, that's good, because that's what we're here to talk about tonight, how we can do some damage together over the next 10 years. Hey, Amy. All right. So what have I got for you tonight? Tonight's agenda consists of, I'm going to share a concept called accumulation phases. And I will share a little bit about my own personal journey, and through dumb luck have just sort of stumbled into some pretty good market timing throughout my career. And I'm going to help you guys clarify your goal, because ultimately this isn't about me, it's about you. And so I want you guys to leave here with something concrete and crystallized in terms of what you want to do. Catching a little feedback. All right. After that, I'm going to just open up some case studies. I was really geeking out on the math, and I was going to show all these spreadsheets, and then I realized, tell them the time, don't build them a watch. So I'm going to do simplified versions of the case studies. If any of them are of interest to you and you're like, hang on, I need to see more of that, I have all the spreadsheets built out, happy to share them. I just, for the purposes of slides, big spreadsheets don't exactly communicate well. So you're going to see simplified versions of case studies tonight. And I'm going to go through the 3 myths that I have identified that are currently destroying people's dreams and wealth. And then I'm going to unveil, I've given it a cute name, it's called the quantum strategy, and it's just something that I'm personally dabbling with, and I'll introduce it to you as well. And you guys will walk away with an implementation plan. So that's the idea, is like, how are you going to take what you've learned and implement it? And then of course, Q&A, ask me anything, open book. All right, so most of you guys in this room know who I am, but for those that don't, I'll just do a quick run through on my resume. Nice if those monitors were running. Is there any way to get those monitors going there, Sammy? No worries, though, either way. So my resume, I've been involved in over $3 billion in residential real estate transactions. Our property management team manages over $1 billion in property management assets. Been involved in over $100 million of pre-construction project sales within our group, and over $100 million of development and construction. I also manage some capital on behalf of a number of limited partners. And been doing this, been at this racket about 22 years. So not my first rodeo. I do carry 4 different licenses, so well equipped to be your steward tonight. I'm also a certified real estate investment advisor, and this is my favorite aspect of the business. I got involved in the real estate investment network back in 2008, and then by 2012, I had my own chapter here in Kelowna. And I got to do this for a number of years until COVID happened, and then unfortunately kind of meetups and events sort of died for a couple of years, and then Rain didn't come back to the table with an Okanagan chapter. So it's cool for me to be able to do this again, get in front of folks that are interested in growing their wealth and talking about real estate. This is my favorite subject to talk about. I write for Canadian Real Estate Wealth magazine. A lot of our partners and investors actually found me that way. I've been featured on Bloomberg TV. We have the endorsement of Barbara Corcoran, Scott McGilvery from HGTV. And yeah, so very much in this space, in this thought leadership space of real estate investment. I don't know if you guys, does anybody see our YouTube videos where we put out kind of what time it is in the market? Right on. So yeah, you guys can Google or YouTube search me, and I put out these types of market reports where I just try to give you, read the tea leaves and help you make informed decisions on real estate. We are your one-stop shop, so the Vantage West group of companies can kind of help and handle just about anything. We have real estate investment advisory, we've got residential and commercial sales, property management, home services, so any kind of renovations, things like that. We do pre-construction project sales, development and construction management as well. And then of course we have our limited partnership where we manage some capital on behalf of some partners. So whether you're a total DIYer, you're here to kind of just grab a tip or two and do it yourself, or whether you like to have a team of people helping you and guiding you and consulting you while you make your own investments, or whether you are a total armchair investor, you want to sit back and relax and let somebody else pick up all the effort and the grunt work, you're in the right place. What you'll learn tonight will help you regardless of where you stand. Now, who was on our online investor event we did about a month ago or a month and a half ago? Okay, so a good number of you. So tonight we're kind of piggybacking on that. I'm not going to re-go through all that information. We did send it out in advance as well for folks so you could watch it and be up to speed. But I gave kind of a real deep dive on why I felt that we were here at the start of the recovery. So we've come through the slump, and all of the indicators and all the market influencers are starting to align to suggest that we are at the start of this recovery. So that means we have a lot of pretty exciting stuff to go through before we go back into a slowdown. So as I was kind of reflecting on my journey over the last, say, better part of 25 years, I realized that most of my investing had kind of fallen into these little accumulation phases or these accumulation windows. So I got out of school in year 2000, was a total surf bum for a couple of years in Australia. When I came back, I was 19 and I bought my first house. That was 2002. It was just by dumb luck, just because of the age I was born. When I entered the market, it was right after a crash. We had that Y2K crash. There was about a 10% drawdown at that time. So real estate was on sale. And in that period of time, I was able to get my first house, get my first investment property. I started doing some flips and really just tried to accumulate, a foundation layer of real estate. So I got to acquire in 2003, 4, and 5 some great properties that, of course, did extremely well as we got towards the 2008 peak. Now, of course, then we went through the global financial crisis. That's the exact timing when I decided to open up Vantage West Realty, which is a whole other story for another day. But following that, this was just a hang on for dear life scenario for a couple of years. But following that, we identified that the market had come back into the recovery phase. And so it was here that I'm a little always ahead of myself with these pins, but it was in this stage here in 2010, 11, and 12 where there was an opportunity window. So I started buying fourplexes and started doing duplex conversions, doing a lot of flips to try to generate more cash and getting really good at adding value and forcing appreciation. Some more speculative stuff during this period of time. Tried to flip some condos, didn't do so well, but this is when we started taking a little bit more risk because I had my base layer that I already had and I still owned the base layer of properties from that first accumulation phase. So then, fast forward now, 2012, I'm starting to take some real risk. I'm doing development properties. My wife and I, we combined forces and we decided we were gonna buy a property and carve it into 13 lots and build some homes. We started investing down in the United States, in Arizona, right after the financial crisis. So there was quite a lot of activity, a lot of accumulation in that period of time. No one else was doing this at the time. Everyone else was just kind of waiting. We were going hard. I was fortunate to be plugged into the real estate investment network at that time, and so the group of people, the room I was in at that time was on. They knew it was the time to be buying. And so I had just happened to stumble into that, and I was, I think, just young and ignorant enough to just take everyone's word for it and roll with it, and I did, and it served me really, really well. So then again, owning both these and these properties through this period of time as we got towards 2018, that whole 2016-17 boom that we had, now we were looking really, really good. Net worth was starting to look pretty great, and we were taking even more, risks. This was the decision point where I decided, so I saw the stress test coming in, the foreign buyer tax happening, and there was one other thing that they did, the speculation tax at that time, which we knew was designed to slow the market down. So I was like, okay, there's gonna be another one of these opportunity windows coming. I'm going to put together a limited partnership. So that was the year in 2019 that Cash Offer LP was formed. So then obviously there was a nice run up through COVID, and now we find ourselves at this next moment in time where on the other side of COVID-19, we saw a pretty good sized drawdown. Things have been trading sideways for a little while, and now signs are pointing to another one of these really nice little windows. So to kind of illustrate it, you have these corrections. So right out of the gates, there was this 10% correction that we saw. Then we went through this period of time where we had that optimal buy window between 2002 and 5, and then we saw 125% run up. Then the next one, right, things corrected again, almost 20% during the financial crisis. Then you had that really nice little period of time, that buy window in the green, and then things shot up 75%. Similarly here, we saw that little 8% correction after the stress test. It was a nice little opportunity for a while things traded sideways, and then we had the sort of parabolic increase shortly after the pandemic. So we had that nice little increase. Now, this isn't exactly to scale, but you get the point. So you can see that there are these very simple patterns that are easy to recognize. So we just saw a 15% correction. We've been trading sideways now for a couple of years. Where do we go from here, right? So if you just sort of extrapolate from there and you look at this graph this is what it ultimately works out to. The opportunity windows, as I can tell, on average, last about 3 years, which means we're just entering into the ideal 3-year phase to acquire some real estate. The average increase from the trough to the peak, so the trough we're at now to the peak, is 87%. And the average timeline from trough to peak is 8.33 years. So what I've done is I've taken the timeline and extended it a little bit for all of my projections all the way out to 2035. So as we go through the projections tonight, I'm going to assume that we don't hit our next peak until 10 years out. And I'm going to use the average here, and I'm going to use that buy window. Which brings us to myth number 1. A lot of people, particularly the young people who maybe missed those first 2 cycles, maybe have this feeling in their mind that I missed the boat. Maybe they think that the markets can't continue to climb, right? They're thinking, why would the markets keep going up? Nobody can afford a house. And so you're thinking, I'm too late. All the best deals are gone. I missed it. What's next? And this one, I love this one. I got a good story for this. So some people just think the next generation doesn't have it. They think the Gen Zs can't pick up the torch with the economy and get it going. And this reminds me of an investor that I met. I was actually selling an apartment building for him back in 2009. Really wealthy guy, really charismatic guy, and we became quite chummy. And he was sort of mentoring me a little bit because he knew I was into real estate investing and was trying to get into development. And I told him that I was going to go down to Arizona and buy some properties, some foreclosure properties. And he did everything that he could to talk me out of it. He said, do not do that. He goes, you don't understand. He goes, it was my generation that built the machine. And he goes, have you ever heard the old saying that like, strong men create good times and good times create weak men and weak men create hard times? That's where you're in. And you've got the weak men now. You guys don't have it. Your generation cannot get this economy rolling again. And like I'm looking around at my friends, I'm like, oh, you might be right. And he almost had me convinced. But thank frickin' God that I was going to those RAIN meetings, because I went to a RAIN meeting and there was a person there that was going down to Arizona. They had an RBC person there. They were figuring out the financing for Canadians to be able to do it. And it was like, okay, this is a thing. I'm not crazy. I went down to Arizona. We bought like a dozen properties and it was an absolute home run. So the point is, a lot of people have these limiting beliefs and it keeps them on the sideline. So I want to make sure you don't have those limiting beliefs. The reality is cycles create opportunity. The best deals are not behind you, they're just hiding behind today's distress, right? So history doesn't always repeat, but it almost often rhymes. So if we look at the growth cycle that we've seen from 2000 to 2025, the United States saw a 3.74% annual compounded growth rate, okay? In that same period of time, Canada saw 5.8, so we outperformed. It's pretty good. Now, my second home and where I bought a lot of real estate, and the real estate market I was very bullish on was Scottsdale. Scottsdale is right in that Sun Belt, arguably one of the most attractive areas in the United States to own real estate. And as you can see, it's definitely outperformed both the US and Canada. So I was in the right spot with that. But isn't this interesting? Kelowna, as compared to all those other spots, is the highest compounded growth rate over the last 25%. Now, you might argue that Kelowna was just really undervalued through the 90s, and it was the people who came up from Vancouver and put it on the map, possibly. But there's a few things that we have to consider. So, will Kelowna continue to grow? That is the question. How does it climb, and what forces it to climb? Well, number one, lifestyle. The lifestyle here only continues to get better, it does not get worse. Ski mountains are adding, year-round. We're seeing more amenities, and we're seeing more and more people aware of our amenities. So we're on the map now for having one of the best lifestyles. In fact, the pandemic was very good for that because it unlocked a lot of people. They realized, oh, I can work remotely, and I can work from someplace that's good, not someplace that's crappy. And so they moved here. And so the lifestyle drew a lot of people to the Okanagan, and these are high-earning people who are working in that knowledge work sector. The next thing that Kelowna has going for it is a lot of people who retire. It is, sister cities with Victoria, but the retirees are going to come here. If you've made it in Canada and you're like, okay, where am I going to go and enjoy my golden years? A lot of people are making the choice to come. And if you think about who is the largest cohort still demographically, it's the boomers. And so you've still got a number of boomers choosing to retire here. And then lastly, you just have the diversity of our economy. So over the last 10 years, we've gone from being, a tourist or an orchard town to very diverse. We have, a film and television, we have a tech sector, we have a lot of different, and a lot of people working in the knowledge work sector. So for that reason now, these three things are what really influences a market. So I believe that we're going to see Kelowna continue to at least perform as good as Canada. Do you guys agree that Kelowna is not going to underperform Canada? I think it'll overperform, but for all of my projections, I'm just going to keep it right around the average growth rate. Now, keep in mind, when I show you the growth rates over 25 years, that includes 3 busts in there, okay? You've got 3 downturns. Everything we talk about tonight is just the next 10 years. And for the next 10 years, given that we've just come through the phase of the market where the market draws down, we still get to trade sideways for a little while during our accumulation window, and we get to go through what I think will be a sort of tempered, elongated boom on the other side. We don't have any of the downturns factored in for the next 10 years, and I'm still going to use below what the 25-year average has been for really conservative numbers. So I don't want you to think that these are pie-in-the-sky numbers or that I'm just pumping them up to make real estate seem like it's the best thing. So here's something that I only became aware of a couple years ago. What really drives home prices, as much as all of these lovely things about lifestyle and everything, I mean, that brings people here, and of course, supply and demand is affected by that. But what really drives the value of the asset class that we love is actually something different. Are you guys familiar with the concept, the M2 money supply? Who's heard of it? Okay, good number of you. So what it is the amount of total dollars in circulation. So Canada has a money supply, the United States has a money supply, every country has it. And our money supply is very much linked to the United States money supply. That is what it is. And you'll see that here in a second. So Canada's entire kind of circulation of cash has grown from $1 trillion to $2.68 trillion over the period, the 25-year period we've been talking about, from 2000 to 2025. That's a 5.8% compounded annual growth rate. I don't know who's paying attention, but that is pretty similar to another number I shared a second ago. Now, the US expanded their balance sheet from 4.7 to 20.8 trillion in that same period of time. What does that work out to? 5.8% increase. What is going on here? So you got the Canadian M2 money supply has gone up by 5.8%. You've got the US money supply is up by 5.8%. And lo and behold, Canada's real estate has gone up on average by 5.8%. Do we think that this is a coincidence? Do we think that this is just like dumb luck? Or is there potentially a correlation here? My contention is that they're just debasing our currency, and real estate is a hard enough asset that it can keep step with the amount of currency that they're injecting into the market. Does that make sense? There's been these periods of time where they've been forced to inject lots of currency into the market. So after 2008, huge amount of cash came on stream. After COVID, a bunch more stimulus got pumped in. And so this will continue to happen. Well, I should ask the question, will they continue to print? That is the million-dollar question, because if that is what drives real estate values, then the question we should be asking ourselves is, will the money printer continue to run? So I'll share with you why I believe that monetary expansion is virtually guaranteed, okay? Number one, we do have aging demographic, and they have entitlements, whether it's CPP, old age pensions, all that stuff. And so with soaring costs of Social Security and Canada pension, healthcare, all that stuff, there's going to be fewer workers, obviously birth rates declining, fewer workers, which means a shrinking tax base, which means less of us to pay for a growing number of entitlements, which is a big problem. It's probably the number one problem that politicians talk about behind closed doors. So the reality is governments will print rather than cut, because if you could imagine trying to tell a bunch of baby boomers that we're not going to honor those agreements, it's going to be a challenge, especially politically. So they are not going to do that. They're going to print. The next is there's unstable debt loads, particularly in the United States. They have trillions of dollars of debt that have to be refinanced on these cycles. So there's $34 trillion coming up to be refinanced again. They want to refinance those at lower interest rates because it's much easier to service. The service cost of this debt is massive. And so printing money allows them to pay back that debt with inflated dollars. So they will continue to inflate away the debt problem and pass that buck down to the next generation. The financial markets and all equities, they've become sort of addicted or dependent on this, right? Crypto, equities, housing, all of these scarce assets rely upon easy money. So every tightening cycle is always followed by an easing cycle. We just came through the tightening cycle. We know where we are now. And so you get this higher floor, bigger deficits every time. So the consequence of that is that central banks are just trapped in this liquidity death spiral. They have to keep printing money. There's a concept called modern monetary theory, or MMT, and there's a lot of politicians, including the Liberal government and Mark Carney, they subscribe to this idea that modern monetary theory will solve the problem. Basically it means deficits don't really matter, we'll just print away the problem. And the public also expects this. There's been a shift culturally where there's a public expectation that the government will just continue to do this. And so I believe that money printers are now a standard policy tool and they're not going anywhere. The bottom line is that monetary expansion, the thing that drives our favorite asset class, is actually a structural issue now. It's not a cyclical thing. It is structurally built into our economy. So you can expect more liquidity, more debasement of your currency, meaning you're going to have to bring a larger and larger pile of cash to buy the things that you like. But if you are holding the asset class, the scarce assets, the things that tend to do well in inflationary times, you will win. And you can pay a little more for eggs because your house went up by $500,000. So another myth, and I just threw this one in here last minute because it felt apropos given the week we're in. There's a bit of a myth right now from people we're talking to within our firm that, well, this all makes sense if the conservatives get in, or this all makes sense if we get if Mark Carney gets in. And they think that their plans for real estate investment are going to be dependent on who holds the office at the federal level. And I'm here to tell you, there's different reasons why they're both good for real estate. I did a deep dive on this. I went into ChatGPT, I did a deep research. I got like a 48-page document and I studied it. And what I've found is that both of their platforms work well for real estate. For example, if Carney gets in, he's going to run larger deficits, which means they're going to fire up the money printer. There's a whole host of reasons why I don't love that, but real estate values will go up as a consequence of that. Conservative government's going to come in and they're going to try to stimulate the economy. They're going to try to grow their way out of it. They won't expand the balance sheet, but they'll improve the economy, which of course then also, from a fundamental standpoint, really drives the market. Increased GDP, people making more money, the resource sector happening, people from Alberta crushing it again, all of that stuff, removing red tape, all of that stuff will be good for the market. It won't be because they expanded the monetary supply as much. They still will continue to expand it. But both are good. So either way we win. There's 1,000 reasons why I don't want to see one side win, but real estate prices are not that. Real estate wins either way. And I think that's important for everybody to understand because politics doesn't really come into play with this. The real estate, it's structurally built in now. There's no way that it can't continue to go up. So if that's true, if it's really intrinsically tied to the money supply, then our home is really becoming more valuable. Is that true? Well, let's do a little reality check. So let's assume that you converted all of your income to gold, right? You went and bought yourself, every time you got your paycheck, you went and bought yourself an ounce of gold, right? You converted your money. Now, of course, I didn't do that. I wasn't smart enough. Still needed dollars. But if you did, if you denominated in gold, then real estate is actually cheaper. If you take the average house price of 2015 and divide it by the price of gold at that time, then you needed 478 ounces to buy an average house. Now you need less. You need 426 of these little bad boys to buy the average $1 million house. Kind of neat. Similarly, if you were to take your cash and throw it in the S&P 500, this isn't something that I personally subscribe to, but a lot of people do. If you were to do that, the S&P 500 in 2015, if you were to buy an average home, you would have needed to have 268 shares of the S&P. Now you only need 196. Pretty cool. And then Bitcoin, of course, the darling of the decade. If you were smart enough, and I certainly wasn't, but I got a few of these things. If you were to, this is just my little cold storage Bitcoin here. If you were to have bought an average house in 2015, it would have taken just over 1,800 Bitcoins. Now it takes 12. It's not long before it takes 1. We're not far off, based on the trajectory. So, why real estate at all? If gold has been outperforming the monetary supply, If S&P 500 has been outperforming it, if Bitcoin has been knocking the socks off of it, why are we here talking about real estate? What's the point? Just buy those. Well, there's two things that real estate has going for it, the other two don't. Number one, margin. You can buy this stuff on very large leverage. And number two, cash flow, which means you have the money coming from your tenants to pay that debt. So you can borrow, banks love to give you collateralized loans against real estate, and your tenants will gladly pay that debt off for you. And for that reason, real estate tends and continues to be the best investment vehicle to get ahead and to become wealthy. So, why real estate still wins? You can buy $1 million asset with $200K. Control the entire thing. Cash flow, rents pay your debt. You get tax advantaged equity growth, which is pretty sweet. And of course, it's the leverage that acts as a multiplier. Okay? That's what's providing the outsized returns. So to illustrate, you look at, okay, let's look at a leveraged investment versus non-leveraged. Take the average house, $1 million. All my examples tonight are just gonna be based on the average single family for $1 million. Doesn't matter what price you use for your own projections, but I'm trying to keep the math simple. Let's assume you bought a $1 million property with a 5% cap rate. Here's what it looks like over 10 years. You would appreciate roughly $600K. You got $550,000 worth of cash flow because you had no debt, so you get to put the cash flow in your jeans. And your total equity gain is just over 1.1 million. It's not bad. 11% annualized return. Not bad. Now, if you took some leverage on it, you could take that same $1 million and spread it over 5 houses. Let's just look at one. Put $200K down, you get a 6% compounded growth rate, same thing. You get $239,000 worth of principal pay down during that period of time. You don't get, I'm just assuming cash flow neutrality. So no cash flow. You can do better than this, but for simplicity, cash flow neutrality the whole way through, which means you made $848,000, but you made it on $200K, which means you're 424% return. So in just one market cycle, from the trough to the peak, you 4x'd your spending power on that $200K. And that's just the simple power of leverage. Who's here familiar with Raoul Pal? He's got Real Vision, probably one of the smartest plugged-in macro investors of our time. My brother actually turned me on to him a few years back, and I watch him religiously. He's got, I think, the best handle on it, and so he coined the term "unfuck your future," and I think it's apropos because that's what we're trying here to do tonight. And my contention is that 3 investments made during this next accumulation window will absolutely unfuck your future. It can bring your retirement closer to you. It can, if you're 30 years old, it can be the thing that allows you to retire at 45, 50. If you're 50, it's the thing that could get you there at 60. If you're 60, it's the thing that can get you there and very comfortably. So a quick case study. Let's just look at what would happen if you put 3 properties in your portfolio during this accumulation window, right? So you've got 3 properties acquired. I used buying 1 a year, so they went up in value a little bit. The first one was $1 million, the second one was $10.50, the third one was 1.1, just because I'm applying the growth rate. You need about $630K of cash to do that, so obviously you're earning and figuring out a way to cobble that together over the years. Using our assumptions on 6% growth, you end up with a $6 million portfolio. By 2035, you've got equity in that portfolio of $3 million. You can access 80% of that equity by way of a home equity line of credit and put $2.4 million in your jeans tax-free. That's doing nothing, just buying them. This is the super vanilla strategy, okay? ROI on that is 375%, pretty strong. Now, some people go, I don't want to do this because tenants. All I hear is horror stories about tenants. I don't want to get involved in that. I don't have time for that. And I've just heard too many nightmares. I'm not doing it. And the tenancy laws in BC suck, so I'm not doing it. Okay. But there is a way to empower the tenants and to mitigate most of that risk. And I'll just share with you what those are. This is what we do in our property management team. This is how we manage to, I'll show you our stats here in a sec. So number one, you gotta have an amazing screening process. You gotta screen tenants like crazy so that you're only letting the cream of the crop through the filter. Next, you gotta treat them like clients, or if you're managing them, like for us as managers, we treat them like clients. Even though we don't have an agency relationship with them, we wanna give them some version of the client experience so that they don't feel like they're in this adversarial relationship. That's the problem with landlord and tenancy, is it typically feels quite adversarial. We want to make them feel as though they're our client. Or if you're managing your own properties, make them feel like a partner, because in some ways they are. They're the ones that are caring for your asset. And by the way, they're also paying off your debt, which is where all the gold comes from. So I think it's smart to treat them like partners. And then of course incentivize on-time payments by sending a cleaner every 6 months. Little things you can do to gamify the behaviors that you want. And then be responsive. If you look at all of the one-star reviews we've ever got, it's always because we weren't responsive enough from when they made the complaint about the leaky toilet or whatever to when the person showed up, the plumber showed up to fix it. If 8 days go by, they're on Reddit forums calling you a slumlord. So this is where the problems come, and then they want to withhold rent and all those things. The lack of responsiveness is responsible for almost every problem we've ever had with tenants, and we've learned this lesson the hard way. I certainly have. And then of course, for us, we want to educate and empower our tenants. We want to help them break the cycle of paying our or their landlord's mortgage and actually help them get into real estate. That's what we love. We love this. So let's use it as like a mentorship program to get people in and to onboard them into real estate. The thing that they're helping us succeed at, we can help them succeed at it too. And we can find another tenant who will pay more than them on the other side. So for us, a lot of people have this idea that a lot of people don't pay. We have a 99.69% collection rate because we've used these strategies, which means that for every 100 grand we bring in rent roll, we lose about 310 bucks. That's the slippage. It's not much. And then there's the arbitration. This is where like the real ass pain comes when it comes to landlord tenancy stuff. So what is our arbitration rate? I ran the numbers because we track all of it. We had a 1%. So 1 out of 100 tenancies that we have ends up at the real estate tenancy branch. And it's usually always people fighting over a damage deposit. That is pretty much 80% of them. And we have an 80% win rate on these. So I mean, look, unless you're going to have 100 tenants, the odds are you're not going to experience an RTB issue. So it's not as bad, but you have to do it well. You have to manage your property like a pro. You can't do it as a slumlord. How are we doing so far? Is this good? All right. I'm kind of like a teenage girl. I need a lot of validation, so appreciate that. So good. Thanks, I appreciate that. Can we take it up a little notch? Yes? Okay, cool. All right, let's take it up a notch. So returns increase with the velocity of money. What do I mean by that? So you can just set it and forget it. That was sort of the vanilla strategy that I shared with you. But I have gotten ahead and I've been able to accumulate what I have because I really try to jack up the velocity of money, meaning that as soon as I can take cash out of a property, I'm taking it and I'm doing something else with it, something even more exciting. And so I want to share with you how you can use a similar strategy, and I'll kind of go progressively here in terms of like increasing your risk appetite. But here's what it looks like when you, say, take it to the next level, which is a BRRRR strategy. So BRRRR is just buy. Now you got to get involved in renovations, so you have to have a bit of an eye. This is where expertise starts to come in. You have to have a bit of an eye for how you can value add, but then after you've renovated it, odds are you've increased the value. You've also increased its ability to command higher rent, usually more rent than the new mortgage amount you're going to take or the home equity line of credit amount you're going to take. And then you refinance it. You pull that money out and you're actually a little bit better off cash flow wise. You have most of your cash back and you can go and do it again. And that's how a lot of investors, and this is, I didn't come up with the BRRRR strategy. This has been told ad nauseum across every investment forum, but it is still the tested and true strategy to be able to take a small amount of capital and continue to recycle it. So that's increasing the velocity of money. So it looks like this. Like you buy that same house, you put your 250 grand down on it, and you put another $100,000 into trying to force value appreciation. When you refinance it, you can take $937,000 of debt on the new value, which pops out a good chunk of your cash back, right? And you can go and you can do it again. So the case study, if you were to do this, let's say you had enough capital to do one deal, and your goal was to get in and out of each deal on an annual basis, which is totally doable. You go in, you buy it takes you 3 months to renovate it, put the tenant in, you allow that to kind of happen for about another 6 to 8 months, and then you start working on refinancing it. Not a huge undertaking. So what it looks like then if you do that, your 3 properties acquired, same math, your 3.15 in total value on the acquisition, you need about 400K. That's your initial deposit plus the amount you have to top up each subsequent purchase to do this strategy. In 2035, again, you've got a $6 million portfolio. Your equity is a little higher now. You're 3.45. You tax out refinance. You're 2.7 million this time around. and your ROI has now gone from just under 400,000 to 650. So forcing that appreciation changes your return enormously. So it really does make sense to not just look for properties, although you'll do wonderfully if you just bought properties. You should be looking for properties that have some latent value, some properties that have some low-hanging fruit where you can go in there and influence its value in 3-4 months with another 100 grand. But let's take it up another notch from here, shall we? This is where we now introduce a margin of safety. So this is what we do inside of Cash Offer LP. Everything that we buy has to be at least 15% back of its appraised value, of its true market value. Now this can be challenging. The challenge here now, so in the second one, you now have to roll up your sleeves and start doing some work. In the third iteration, where you're gonna see there's even way better returns, now you have to do another job, which is you have to find deals. You have to put a network together. You got to find wholesalers, real estate agents. You got to maybe do some advertising. You see people out there saying, I'll buy your home for cash. You see all these people sending you, who gets those flyers in the mail? They're like handwritten. It says, I have a buyer for your home, or I'll buy your home. These are people now taking on the legwork of trying to find deals. And you got to kiss a lot of frogs to get to the prince. You got to make 20 offers before somebody accepts one. That's just the nature of the beast. And that's what we've scaled up Cash Offer to be able to do that. But many people do it. What we're doing at Cash Offers is just a strategy that people have been doing for decades by themselves. You just have to fire up the marketing machine and be willing to do the work. But if you were willing to do that work, here's what it looks like. So now you take that same $1 million house, but you don't pay $1 million for it, you're buying it for $850, right? Same thing, we're rehabbing it, putting 100K into it, same exact metrics. We're getting pretty much all of our cash back, and we've created 300K in value. So if you were to do that, again, the same exact metrics, here's how it changes the numbers. 3 properties cost you 2.7 because you didn't pay $3 million and change for them. You got them at a discount. The net cash required is just the initial cash you needed to buy it and your renovation money. You still get to $6 million value. You have 3.2 in equity by the time the dust settles because you have lower mortgages out of the gate. And you tax out refinance 2.6 million and give you an ROI of almost 1,000%. So this is where the real gold is. Let me ask you a question. If you got that level of return, could you change your future with that?
Yes, sir.
Yes, sir. All right. I'm gonna show you guys something even spicier. So, where am I? Any Bitcoin bugs in here? Any Bitcoin maxis? All right, couple? Okay, so about 2020, I think I started getting into Bitcoin. And I read a book called The Bitcoin Standard, and it convinced me completely that this is perfect monetary theory, this is where things are going. I'm not gonna get into all of it, but I'll just share with you that I was convinced in about 2020 that this is where things are going. So what we're seeing now is that there is a bit of an opportunity in combining these assets. And so this velocity of money that I was talking about, the refinancing and reinvesting, can be done with a combination of assets, which some of them are going to be steady Eddie and provide cash flow, and some are going to provide an asymmetric upside. And what's interesting about Bitcoin is the same fundamentals, the scarcity of it, the fact that it tends to be an exponential growth when they turn on the money printer, all that stuff, they go hand in glove together. And so Bitcoin has appreciated at a compounded growth rate over the last 10 years of over 80%. There's a gentleman by the name of Michael Saylor. Does anybody know Michael Saylor? He is probably the most intelligent person on the subject matter of Bitcoin. He's a Bitcoin maxi. He doesn't play with any of the other cryptos, but he's built this model. And what the model suggests is you can see over time the price of Bitcoin, and you can see that the compounded growth rate goes down over time as the adoption rate increases, the volatility moves out of it. As its value goes up, so too does the returns compress. But you look at the model, and you can see here that by 2035, he's got it at a $2.1 million Bitcoin. Average compounded growth rate during that period is 35%. So less than half as well as it performed over the previous 10 years, which makes sense. It went from a small market cap to now it's north of 2 trillion. So that makes sense. But this model has been scary accurate, and he is scary smart. So I personally am, in my own investment, believing that there is a pretty solid reason to have some exposure to this asset class as we go forward. But I want to do it in a way where it's real estate first, Bitcoin second. So I've come up with this little concept. This is just something that I'm doing in my own portfolio, playing around with a little bit of my own capital. 3 Bitcoin, it's nothing crazy. But I'm trying to create this liquidity engine where we take real estate that has appreciated, refinance it, take some of that cash out tax-free, invest it in the Bitcoin goes up, you can take a collateralized loan against the Bitcoin, the real estate cash flow can still cover that cost, and you take that money and you buy more real estate, and the cycle continues. So when I look at that, and I play with that, you got tax-free liquidity, you have dual assets compounding, you've got crazy collateral efficiency happening. It's very market adaptive, meaning you can go back and forth between, if Bitcoin's down, you can go a little heavier on it. If real estate's ramping up, you can go a little heavier there, so you can go back and forth. And both are built to absolutely crush for the next 10 years. So I think it's cool. Grant Cardone is doing the same thing. Cardone Capital just launched their innovative fund, combining real estate stability with Bitcoin's asymmetric upside or growth potential. So Cardone's doing it. More people will follow suit. So we're calling that the quantum liquidity engine for now. It's my little trademark on that. And I'll make the assumption that for the purposes of this model, real estate does the 6% as we talked about. Bitcoin's 10-year growth rate is 35%. And let's just, for simplicity of math, start with $1 million of starting capital. So here's what it would look like. Purchase $1 million home for $850,000. So we're going to execute that model still. Spend 150 grand that we're doubling our cash on it. Same exact thing we talked about before. Gives us an after reno value of $1.3 million. We get our $1 million back. We paid cash, we borrow, we get our $1 million back. Take the $1 million and split it. 500,000 goes into Bitcoin. You're buying roughly 3 Bitcoin, let's say, because this maybe takes you a year to do. And you take the other $500,000 and you go and you buy yourself at 4-to-1 leverage, some $2 million worth of real estate, right? $500,000 deposit against $2 million worth of real estate. The Bitcoin, based on the 35% compounded growth rate, will double in 2.5 years, which means you've got, in 5 years, $2 million worth of Bitcoin. So at that point, volatility would have been kicked out of Bitcoin even more. 50% loan to value, very safe. Take a 50% loan against the Bitcoin, you get your $1 million back. So your $1 million has popped out now twice in 5 years. Take that same $1 million, you go buy $4 million worth of real estate in that period of time, and hold everything, just do nothing after that. Just hold it for the next 5 years. Here's where you end up, the outcome. You got 11 million in real estate, 10 million in Bitcoin, and internal rate of return is north of 35, and you have $21 million in assets by 2035. So that's just a little game I'm gonna be playing in the background. I think it's kind of cool. I wanted to show it to you guys. Is that okay? Did I lose anybody? Too complicated, too risky, too scary? All right. So there's this little pyramid that I want to show you, and it's the economics of market segments. So I've obviously been increasing the risk tolerance and going up the chain here. But the way you want to look at it is you want 80% of your wealth stored in a base layer of stability, predictability. These are your long-term buy and hold single family rentals. That is your blue chip, those 3 that you need to un-F your future, right? You could also, if you prefer triple net leases or if you prefer apartment buildings, absolutely fits in that space. Really, really safe, kind of boring assets, right? So that's what you do with 80% of your real estate portfolio. That's where you want to start. Then you get a little spicier. You start looking for some more speculative stuff. You maybe get involved in some real estate developments, maybe some limited partnerships, maybe you're speculating on condo projects, syndications, value add stuff. This is where you're getting a little bit more cute with your capital, but you've got the base layer, right? And then you've got the 5% where you're looking for that asymmetry. This is where you might play a little in the crypto-backed stuff. You know, look for really speculative stuff, the pre-con deals, development deals, that kind of stuff. That's the spicy sort of tip of the pyramid. So I want you guys to consider kind of where you stand right now with all of that. There's a gentleman by the name of Scott Trench. He has a podcast, Bigger Pockets. Who listens to that? Yeah. So that pyramid comes from Scott Trench. But if you're not listening to this podcast, I highly suggest that you do. This is probably one of the best podcasts on the subject matter and has provided me with lots of inspiration over the years as well. Cool. An advanced strategy that we are doing inside of Cash Offer LP right now and in CO developments is trying to create some affordable housing. There are some programs available right now called the MLI Select program, which allows us to build this type of asset at insane margins, like 20-1, 5% equity, 95% debt, which creates a pretty amazing upside. So When you look at the MLI Select program, and Caleb, you know all about this, you're getting 20-to-1 leverage. You're also getting insured debt, so if CMHC is willing to give you the money, they've de-risked your deal. You're also getting that money over 50-year horizons, which lowers your payments like crazy, and you're getting rates you couldn't get otherwise. They lower the rates probably 100 basis points below what you would get if you were to just go try to finance an apartment building conventionally. So if you look at, okay, how would someone in a DIY scenario do this? Let's say you had $500,000, okay, to invest. What you might do is you might use that $500,000 to buy a house on a parcel of land, something, you know, half an acre, give or take, right? And then you go to work designing a $10 million building, which is roughly going to be $8 million worth of construction value. You're looking at 20 to 40 units, depending on the size of units and what you're trying to do. And those, by the way, are a sweet spot for multifamily. The 20 to 40 is a really nice sweet spot for multifamily investment. Your goal is just to try to create 10% in value. So if it costs you $10 million to put this thing together, you want it to be worth $11 million on the other side. And hold it for 10 years. I actually dropped the compounded growth rate down to 4.5 for this, just because it's a little bit more tied to rents than it is the real estate market. But that multifamily goes up by a little bit less. So I dropped it down. So instead of it going up to 19.6 million, I took it up to 17. The cool part is you pay no property tax for 10 years, which will put hundreds of thousands of dollars back in your jeans through the holding period, which you can use to aggressively pay down debt. Pay no GST, so when you have 5% of your cash in the deal and you suddenly don't have to pay 5% tax, that's a big deal. It's a double up. And then what's really cool is that for the next 5 years, you can use what's called a capital cost allowance, which is the federal government's attempt to stimulate this portion of the market so that you can depreciate your building and write off any gains that you make. So basically you have 5-year little glory window where you're paying no tax on any of the cash flow that you're spitting off. So I would use that window to aggressively pay down the debt, and I'd pay my debt down to $8 million because you took a pretty big mortgage. You got the 95% mortgage, and then what that allows you to do at the end of the 10-year run is an equity takeout, 75% loan to value because you got to go conventional now. CMHC thing is over if you want to refinance it, and you can pull $5 million out tax free. There's 1,000% ROI, 10x your cash in 10 years. Now, I don't want to simplify this. It's not an easy thing to execute. Okay, there's personal net worth covenants. There's a fair amount of understanding required to put a deal like this together. But I want to show you what's possible. There are a lot of people right now trying to assemble 1 or 2 lots downtown, or some of these places that are just outside the city core that have, like Vernon, for example, has really good economics where you can buy a piece of property for $1 million that you could put 30 or 40 units on. And so this is a great strategy, but if you haven't done it before, it's probably smart to align yourself with someone who has. Which brings me to the myth number 4, which is it's got to be me. Who kind of suffers from this, where like, if it's meant to be, it's up to me. I cannot hitch my wagon to anyone else. I have to be in full control because I feel like as soon as I'm not in control, my risk level goes way up. I was actually one of these people. I am a bit of a control freak in this regard. And so I actually had this belief of mine shattered not too long ago. A friend of mine who is a pretty astute real estate investor in Alberta, he found an apartment building in Sylvan Lake. And he called me up and he said, hey, I've got this great deal. I think I'm stealing this thing, a couple $100,000 back of what it's worth. I got the financing all figured out, but I don't have enough cash to do it. He's like, do you have any cash? I was like, I'm not getting involved with you. And he goes, no, come on, this thing's really good. Let me send you the numbers. I said, okay, send me the numbers. Lo and behold, the numbers were good. And I have so much going on at this period of time. I'm already doing cash offer LP. I'm managing other people's cash. I got a bunch of deals going. But it wasn't a lot of money. He needed $100K to top this thing up. Basically, it was $1 million purchase, and he was short 100, so I came in for 50% of the cash. And he says, listen, I will manage it. I'm going to go in there. I'm going to renovate it. I'm going to get the rents up. And he's like, this is going to be a home run. I said, sure, whatever. It's $100,000, and I just didn't think about it. Every couple months, he would send me an update. Oh, the rents went up from $800 to $1,200 on the 1 bedrooms. Oh, the rents went up from $1,500 to $2,000 on the 2 bedrooms. Oh, I'm just renovating the roof right now. Oh, I'm just changing out all the toilets. And he's managing this and doing everything, and I'm going, holy shit, a lot is going on, and I am not involved. This is pretty sweet. Then we had the building refinanced and revalued and refinanced 2 years later and pulled a bunch of money out tax-free. And I did literally nothing through this whole process. And I thought, that was pretty cool. I had a lot going on, and he did a great job, as good as I would have done. And I don't feel like my money was at risk at any point. So that shattered a limiting belief for me. A partnership with somebody else who is boots on the ground, doing it every day, that worked out pretty good for me. So that's the Sylvan Lake partnership. So if you want the easy button, then partner with a pro. You can hitch your wagon to a pro. There are lots of people out there who are doing this every day, who have the ecosystems built, and are just living, breathing, and sleeping this stuff. Okay. Now, some of you have actually owned real estate. I've been talking to you guys as if you don't own any real estate. The reality is a lot of you in this room are sophisticated and do own quite a bit. Who here has actually owned some real estate and held it through a couple market cycles? Right. Good. Most of the room. Cool. So there's a bit of a conversation needs to be had whether or not you should continue to hold it or should you sell it or refinance it. I call it the hold it or fold it conversation. And so there is sort of an art and science to strategic exits. So we have a bit of a concept called return on equity. This is the thing that you want to be most mindful of. So the question you want to ask yourself is not what you paid for it or the down payment you put in. Like, it's easy for us to lose sight. We'll go, oh, I only put 200 grand in this thing or 100 grand in it 10 years ago. So it doesn't stand me much. But now you have $1 million in it. Okay, you have $1 million of equity in this property. So how's your return against the million? Not your return against the 100K. You can't think of it that way. And a lot of investors, when I sit down with them, they don't really look at it. I know investors that have $1.2 million homes they're getting $2,700 a month rent for. I'm like, you're getting 3%, and they own it outright. Like, you're getting 3% on your money. It doesn't make sense. So you got to look at the total amount of return, so whatever it's going up on average and how much cash flow you're getting, that's your total return. And you got to divide that into the amount of equity that you have, and you got to make that calculation. And then you have to ask yourself, given the fact that as your equity grows, your return on equity is certainly dropping, is it time to refinance, or is it time to potentially exit this property altogether, right? So sometimes it makes sense to just take some cash out and do something else. And other times it might make sense to sell it and carry on. So we have a bit of a grid for this. First thing we want to ask ourselves is, what's the asset's future trajectory? So there's a few lenses. Is the neighborhood that it's in up and coming? Is the neighborhood kind of at its peak? Is it past its best by date? Are we sort of seeing things starting to slip in the neighborhood? That would be one of the questions I would ask myself if I'm trying to figure out if I want to continue to hold it. Then I would ask myself, okay, right now in this moment, are there better returns elsewhere? Are there distress plays, new developments, different things I could get involved in that might be a better home for that money? And then thirdly, where are we in the interest rate debt cycle? Are we entering into a cycle where refinancing actually becomes attractive again? Because to be fair, to refinance your house at 6% doesn't make a ton of sense if you're buying a place that's a 5 cap. But now we're getting back into the space where you can get 6 cap properties and you can borrow money at 4. So we're back into the space where it starts to make sense, and it's going to continue to go down. Now, I took a lot of heat for that in 2012. I put out an article on Castanet, and I basically said the exact same, different numbers, but the exact thing. I said, we're kind of at the recovery phase, money's cheap. We're kind of crazy not to take money against our assets and go and buy more of this stuff while it's still cheap. And there's a guy by the name of Garth Turner. He has a pretty big blog, millions of readers on this blog across Canada, and he lit me up, lit me up. I was gonna put this on here, actually, I was gonna show you the article, but it didn't make it into the deck. But he was going after my hair, the comments were just terrible. They were calling me an absolute swindler for telling people to refinance their homes and go buy more real estate. Now this is 2010, right? Had you agreed or followed or thought maybe that was a good idea in 2010? I was doing it, that's what I did. I was just telling people, here's what I'm doing, and I think here's why I'm doing it, and you should consider it too. Well, if you had followed me down that garden path, you'd be pretty happy with where you were today. All right, so here's kind of the matrix that we use to make decisions on whether or not it's hold or fold time. So there's a continuum from weak appreciation outlook to strong appreciation outlook, and that depends on where you are in the cycle, of course, and also kind of where your neighborhood is at. So you want to look at the properties that you own and think, okay, do I think that, not just in a vacuum, but as compared to other real estate assets or other assets I could get into, do I have a weak appreciation outlook with what I have here, or a really strong one? Where am I on the continuum? And then obviously based on refinancing, you need the cash flow for it. So do I have low cash flow potential or high cash flow potential? So For example, if you had a very weak outlook on appreciation and low cash flow potential, that's an immediate sell signal. Like, just get rid of that, get your equity out of that immediately. If you have really low cash flow potential but really strong appreciation outlook, that's probably a hold until 3-4 more year hold. Capture some of this next upshot and get the heck out of that and find something that cash flows, right? And so based on where you're at with your property, it might make sense to refinance or sell, and I'm more than happy to sit down with you and help you guys make those decisions. So, questions you want to ask: can I access equity without triggering a tax? Yes. Home equity lines of credit are totally tax-free. And then they're proposing something that is, are you familiar with this? If the conservatives get in, they're proposing this 1031 exchange equivalent. So in the United States, every time I've sold one of my properties in Arizona, as long as I buy another one, I don't have to pay any tax. So if I make a couple $100,000 on a property, as long as I buy a property of like kind and value, no tax. They're proposing something like that here in Canada, but you don't actually even have to buy real estate. It's a step even further than that. You can literally put it, as long as whatever you're buying is Canadian, you're good. So if you're buying a Canadian small cap company, good to go. A Canadian business, whatever. So that's pretty exciting. The opportunity cost of idle equity is a lot less exciting to me. So I say access that equity by a tax-free refinance, reinvest into high yield assets, and let's keep the velocity of money going. So I ask you then, how many of you have equity sitting in properties that's earning you less than 5%? Anybody? Yeah. What would the portfolio look like if you could deploy that at 12% or better after tax? That's the question. So if you want to sit down and just chat that through, I have a whole tool that I use. We plug in some of your numbers, your mortgage balances, your cash flow metrics, everything. I'll get you your return on your equity calculation. I'll also be able to future forecast what that looks like over the next 10, even 20 years, give you different refinance cash opportunity or junctures, and help you make decisions. We do this with investors all the time, especially with the property management side, so that they know how to keep their equity working as hard as possible. So if you're interested in that, you can snap a picture of that and that'll go right into my calendar. All right, have I convinced you guys that there's opportunity out there? Yes? Okay, sweet. Have I convinced you that the timing is potentially good? You like the timing? Sweet. Okay, then it's time to commit to something in writing. In your guys' books, there's a little business card, okay? The reason why I'm doing this is I attended an event in 2015, a Phil Town event. It's called Rule 1 Investing. And he did this exact exercise. And I thought it was pretty cool, so I wanted to replicate it. I've had this in my desk for 10 years. And it's just a little promise to myself, right? So I, AJ Hazzi, promised to myself to have a net worth of buy, and I had to sign off on it. Okay? So I made a little promise to myself. Now, I know it sounds hokey, but I think this stuff matters. I was talking about this, I was on talking to a number of young kids that are 15, 16 years old, like grade 11, 12. They're in an entrepreneurship program. And they asked me what was like the secret sauce to, whatever success I've had. And I said, honestly, it's just been really intentional and thinking in 5 and 10 year increments and being like crystal clear on what I wanted and speaking that with clarity and conviction. And so little exercises like making a promise to yourself and signing off that you're gonna do it and dating it is important. In our office, we do letters from the future. So similarly, we will get our agents to make a commitment to being at a certain place and speaking to it as if it has already happened and make a guarantee to themselves that they're gonna do it. It's important, so I would just ask you, I know it's as silly as it seems, to take this, make the little promise, date it, sign it, stick it back in your pocket. I don't even want it. Just put it in your desk and keep it there. And then it'll remind you. I have it whenever I pull my keyboard out from my computer, this stupid thing staring me in the face, like, oh, I made that promise to myself. Right? And what's cool about it is I've actually hit the goal. So I'll give you guys just a couple minutes. How are we doing for time here? Not bad. Not bad. I would tell you that most people massively overestimate what they can do in a year and massively underestimate what they can do in 10 years. I've shown you strategies tonight that can get you 4x returns, 6x returns, 10, and one that even did 20, right, over 10 years. So anything is possible. The reason why I want you guys to commit to something is because then I want to get on the implementation side of it here in a second, okay? Just give you guys another second to do that. Can I get a water, Sam? See, the pens are mostly down. Let's keep rolling. Okay. In order to implement this stuff, you kind of need to have a few things going, okay? So I call this the 3 C's of successful investing. You need capital, you need confidence, and you need a commitment, okay? So I'll break it down a little further. So on the capital side, you need both cash and credit. In order to get a real estate deal done at leverage, you need to both have the down payment, but you also need to be able to get the money that is required to leverage it. So cash and credit, that is paramount. There's a reason why it's sitting at the top, okay? Cash is king, credit's queen, and they sit at the top. After that, you've got confidence, okay? And so the confidence in what? Well, the confidence in the strategy that you have to make sure that you've figured out what your buy box is, right? You don't want to do a bunch of things. You want to do one thing really well. So if you're going to take on the BRRRR strategy, that's all you do until you've hit your goal. Follow one course until successful, right? So you have to have confidence in your strategy, and you have to have the skills to execute the strategy well, okay? And so that's a very important piece. It's hard to be confident if you don't have the skills, and it's hard to be confident if you don't have a good strategy. And then lastly, you need to commit. In order to do the strategies I've been sharing with you tonight, you have to commit. You have to commit some time, and you have to commit some energy, mental and physical energy, to driving around, looking at properties, fixing stuff up. You know, there's a lot of things you gotta do, and it takes a lot of energy and a lot of commitment. So if you're lacking in any of those 3 things, that's okay. I'll share with you how you can shore that up, but this is what it takes to win. If you're not playing with a full deck here, I would not recommend diving headfirst into the DIY real estate investment space. So is it cool if I offer you guys a little help with the implementation? Yeah? Awesome. We do have a little 12-week boot camp. So this is the first time I've done it. It's gonna be once a week. We're gonna meet on Zoom, and I'm gonna help everybody actually implement what they wanna do. So I'm gonna go through modules. I'll share with you what some of that are. The point of it is going to be to dial in your strategy, upgrade your skills. So if you're short on the confidence aspect, this is really designed to get you unstuck there. And then you're going to want to build a dream team. Whatever expertise you're missing, you're going to want to build that dream team, because one person does not make a successful real estate investment operation. You need a team of people to help you. So I'll help you build that dream team. So for those of you that want to go deeper, we've got this complete 12-week investor course. So what I've done is basically taken everything that I've learned over the last 25 years, and I've put it into a 12-week, 12-module outline. Okay, so what we're going to be talking about is, number 1, strategy, the financial fundamentals behind it. So get the right strategy and then figure out what the financing picture looks like. Then I'm going to teach you how to properly analyze deals, and when you're done, you're going to have your own unique buy box. So this is the type of deal that you're going to do based on your own financial situation and your own level of expertise. You will leave with a clear understanding of what your buy box is. Because if you don't have that, then everything looks like a great idea, and you can get very much distracted by the lady in the red dress. So we want to get you absolute clarity on that, and then teach you how to analyze. So I'm going to give you all the tools, the spreadsheets that I use, everything that I use to, go or no go on a real estate deal. You'll get that in the second module. Then we're going to go into how to finance deals creatively. There's some different ways to get stuff done when you are starting to run towards the limit of your capital, and there's all kinds of money mechanics you'll learn. Then of course, once we're financing deals, we have to make sure we're doing our due diligence. So I'm going to walk you through our checklist on everything that we do to safeguard and protect ourselves on these deals, so that you don't end up making a mistake. And then the portfolio management side, or the property management side, I should say, is also pretty major piece of this puzzle. So I'm going to share the best stuff that we do as managers. For those of you that want to DIY it, we'll give you our whole playbook and teach you how to actually scale this thing, the systems and the processes, even the technology that we use. And then our 6th module is the exit strategies, or the wealth philosophy. So how to refinance, how to time it, all of that. We're going to talk about that. And then some really fun, a little more spicy stuff. I'll go deeper on the stuff we talked about tonight, and even some other stuff on the construction and development side. And in module 8, we're going to just really get into action plans, and then from there forward, it's going to be coaching and live deal feedback. So anything that you guys are seeing out there, if you want my advice, you want me to analyze it in real time, that's what we'll be doing on the calls. And so this is a test project. I've never done this before. I have the curriculum. I have taught them all individually. So I've taught the content. I've just never put it and assembled it together in a 12-week boot camp fashion. So it's going to kick off. The first module is going to be the Ugly House Tour, because I haven't done this in a couple of years, and I'm excited to do it. So has anybody done the Ugly House Tour with me? Yeah, some Ugly House Tour alumni. So basically what it is we jump in the bus, the big silly bus, and we drive around. I pick usually 4, 5, 6 properties that have some flipping potential. Now, we're not gonna look at it based on flipping, because right now there's a flipping tax that we wanna be mindful of. We're gonna look at it based on executing the value add BRRRR strategy. So like, how could we buy this house, improve it, suck out the money, and go do it again? So we're gonna look for places that have enough upside potential, and we'll walk through them, and I'll show you exactly where I'd spend money, where I wouldn't, what the renovations would cost, and we'll effectively renovate them on the fly between houses with our little clipboard. It's kind of fun. So it's an opportunity just to learn. It's an opportunity to kind of see how I do things in real, and build some confidence. Build some confidence that there are deals out there, and just to see how somebody who does this for a living approaches it. So that'll be fun. That's going to be the first module. We're going to kick that off. And that'll be in May. Cool. So the offer for you guys tonight is eventually, these will all be recorded, and eventually I'm going to sell this course for $3,000 or whatever it is. But that's not what we're doing tonight. So what I want is to make it, obviously I want you to have a little bit of skin in the game, because if you don't pay for it, you won't value it, you won't show up. So I'm going to charge you something. But what I'm going to do is I'm going to just make it, I'm going to zero cost it. And so that if you utilize any service, whether it's a mortgage broker we recommend, whether it's one of our realtors, a property manager, anything, I'll give you a 20% return on your investment of $500. So I want you to have a little bit of skin in the game. I have found $500 to be the amount that you will not flake out, but then you're going to get $600 back. So I'm actually paying you $100 to come and attend my course and tell me if it's good or bad. I think it'll be good. And you're going to leave there with a dynamite strategy to hit your goals over the next 10 years. Cool? Awesome. Good. So back to this little grid here. If you're missing any cash or credit, coming to this, coming to the course or the boot camp, I will teach you how to raise a little bit of cash. You can find deals. You can go out. You can bug your family or your friends, people that you know that have a little bit of capital, and you can joint venture with them. Joint venturing is a big part of how I grew my portfolio over the years, and so I'll teach you my whole joint venture playbook. So if you're short on cash and credit, don't think that you are left out in the cold. This is an easy one to overcome. Next is the confidence. If you're short on confidence, that's what the whole thing is about. And then of course, if you have no time or energy for this, don't come to the course, because I can't do all the work for you, okay? Or maybe I could. The joint venture option exists for those with if you have no time, if you have no expertise and no desire to gain the expertise, you have no energy to do this, and you're just busy doing what you do, you make lots of money, and you have no interest in this, and you would rather just partner with someone who does this for a living and spends their days all day doing this, obsessing about real estate, and who has a track record for the last 20 years, you have that opportunity. You get to partner with me. There's a handful of people in this room that are currently partners with me, and they get the version of the story that I told, where my buddy did all the work on the apartment building and got the rents up and sends me checks. It's that deal, but for you. Cool. So that takes us to the Q&A, but before we get there, Sammy is in the back. There is a little spot in your guys' book. Wait for Sammy. Hey, Sammy. If you're interested, what we're going to do as a next step on the partnership, if that's of interest to you, we're going to have at our office, it's just going to be a small group, probably room for 10 people at our boardroom table, and I'm going to just unpack every aspect of the fund to the 10 people or so that might be interested. So we're going to limit it to it. We can only really bring on about 8 more partners, because we're kind of already at roughly 42 partners. So we've got room in the partnership for another 8, and so I would love to partner with you guys, but again, it's going to be a small room. So there's a little card in your guys' books there. If you're interested, it just has Sammy's business card on it, or have you handed them out yet? They're up there. Okay, so on the way out, thanks Sammy. On the way out, you would just grab one of those cards and just throw it in the little fishbowl that we've got there, and then Sammy will follow up and book you in for one of the 10 spots. We're going to do that in a week's time at the office. Cool. So that's the end of my presentation. Hopefully you guys got tons of value out of it. I wanted to now turn the floor over to you guys to ask me any questions you want about anything you saw tonight or anything that's kind of on your mind. We got lots of time left. I managed to get through the deck a little faster than I thought, so lots of time left to ask questions, and if we run out of questions, then kick you guys back out to the sunshine. Yes, sir, Caleb.
What are you seeing as basically like tariff impacts on specific products that are obviously cross-border, like as far as budgeting and projects that you're seeing in a couple of ago? Are you seeing any specific products or trade pricing that is increasing faster than anything else that people should keep an eye out for?
Good question. So